It's that time of the week when we recap on global economic and market developments. And boy, has it been an eventful number of days, with US President Donald Trump often serving as a key catalyst in recent events. With the US-China trade tensions worsening in the last week, it's raised the spectre of fears around global growth. It's taken the wind out of the sail of emerging markets, with South Africa particularly hard hit. One of the winners of a most uncertain time has been gold, with the spot price rising above $1,500 an ounce, up 25% from just a few months ago. Well, to take us through some of the developments, I'm joined on the line by Lukman Otunuga. He's a research analyst at FXTM. Lukman, let's try to be chronological about things. When you and I spoke last week, Thursday, we couldn't have anticipated US President Donald Trump's tweet later that day, basically indicating that the US would be levying 10% import tariffs on Chinese goods that were not already subject to tariffs. And of course, markets went downhill from there. Just give us an analysis of what's been happening from that time.
It's been chaos across markets since then. I've been surviving on 2-3 hours of sleep. So I just wake up in the morning and all of a sudden I'm hearing that Donald Trump is going to impose 10% tariffs on $300 billion worth of Chinese goods. Now, this came out of nowhere, especially when we're considering how we thought both sides were, a step closer to securing a trade deal. Naturally, equity markets across the globe crumbled, and on Monday, things intensified further when we saw the Chinese Yuan devaluate past the psychological 7% for the first time in over 6 years. Now, this is really significant because instantly the United States branded China as a currency manipulator. We saw further risk aversion across markets. We saw bond yields actually tumble to its lowest level in 3 years at 1.595. More central banks started cutting rates. Safe haven reached for the stars, and here we are today where there's some semblance of stability, but really nothing's changed.
So why do you think that the Chinese authorities did respond then, instead of retaliating and letting the yuan depreciate even further? They then came in to stabilize it and make sure that it was below 7. Did they want to make a point that actually we're not currency manipulators?
I think there's two sides to every story with this, and we nobody's not really going to know what really happened, because even though it's very easy to say that China did something, somebody can say that China decided not to buy any dollars and just to let the yuan free float, and this is exactly what we saw, because the depreciation was not only on the Chinese yuan, but we saw other Asian emerging market currencies depreciate on that Monday as well. So my answer to that is probably it's just the natural forces of supply and demand, and trade concerns that impacted the Chinese yuan and other Asian currencies. You
really haven't hidden your gold bull credentials, and lo and behold, the yellow metal has really been shining even brighter since.
Yes. I mean, there's no place like gold. We've been speaking about gold for an extended period of time. Looking at gold this week, it's blasted above the 1,500 level, levels not seen in over 6 years. It's year to date, it's appreciated 17%. The last time we saw such a move was back in 2010 when gold appreciated 30%. So this is a real big gig for gold bulls right now. I'm positive on gold. The reason I'm positive on gold is because of 3 things. Number one, I don't see any solution to US-China trade tensions anytime soon. Number 2, concerns over global growth still remain really elevated. We have the World Bank, we are predicting 3.2%. The World Bank predicting 2.6% and IMF predicting 3.2%. And finally, central banks across the globe are cutting interest rates. This year alone, 37 central banks have cut interest rates, in which 13 have cut interest rates more than once. And as we say, gold tends to flourish in a low interest rate environment.
There appears to be real concern around what this means for prospects for the global economy. Do you think that if they can't resolve the US-China trade tensions, that's just going to be prolonged, and because of the psychology and the psyche behind it, it's actually going to mean that economies are going to revert into either recession or very low growth territory?
I mean, this is what we're seeing right here. The fact is that trade tensions over the center, a currency war presents a significant threat to global growth and global stability. And we saw that exactly in the bond market. As I said earlier, 10-year Treasury yields have, tumbled to its lowest level in 3 years, just below 1.6%. And as we know how things work, bond prices tend to rise when there's a lot of uncertainty in the markets and investors are very, very uneasy. This is why central banks across the globe, even though some don't need to, are cutting interest rates as a safety net in case things really get messy.
In the interim, can we expect more pain on the equities front as uncertainty about the future reigns supreme?
It's funny that you say that because I was looking at equity markets today. Equity markets are stabilized. It's been a roller coaster week for stock markets, especially in Wall Street. Wall Street saw its worst decline in a year on Tuesday. Right now, while it's pumping stock markets higher, is still the fact that central banks across the globe are jumping upon the global easing bandwagon, and we know the relationship. Lower rates, corporations make more money. They're willing to invest more. But the question is, how long is this going to last? Because,
that's right.
Well, one side, this is supporting stocks. Really, fundamentally, nothing has changed.
Yeah.
Still trade tensions, still global growth, still uncertainty across the globe. Eventually, something is going to crack, and when that happens, I don't want to be there.
Me neither. What sort of impact have you seen broadly in terms of the impact on emerging markets with this whole risk aversion thing, and why do you think the South African rand has been bludgeoned to the extent that it has?
Yeah, emerging markets are going to be in the direct firing line because they're considered as riskier assets, riskier currencies. Going with the rand, though, the rand has taken a beating this week. I'm surprised. I was shocked when I saw it yesterday weaken to its lowest level in 2019, beyond the 15.0 psychological level. The reason why the rand has weakened so much is because, number one, we had that tweet from, Donald Trump has tweeted so much, but he tweeted something earlier a few days back about the Fed not doing enough. But there's rising concerns that South Africa may be heading for a possible credit downgrade by Moody in November. Now, when we have reports revolving around Eskom, disappointing economic data, we saw the business confidence drop earlier in the week. Manufacturing production is still disappointing. It was minus 3.5% year over year, minus 1.5% month over month. So I'm trying to be positive here, but economic conditions in South Africa is not anything to celebrate about. And if things do not improve, especially with the external and domestic headwinds, South Africa may be heading for an unpleasant surprise in November of a credit downgrade. Even though it's slightly negative, I always try to look at the bigger picture because it's not only South Africa that is facing this. Nigeria, South Africa and Nigeria are considered the two biggest giants in Africa. Nigeria is facing its own trials and tribulation. In the United Kingdom, Brexit is so bad in the UK and it's hurt the pound so much, I'm really hesitant to change my pounds to euros, dollars. But I'll happily change it to the rand because that's a good discount. But all across the world, even in Europe and United States, so this negativity is not only something that South Africa is feeling, it's across the globe.
That was Lukman Otunuga. He's a research analyst at FXTM.